When it comes to buying a home, there's several different ways you can go about financing your purchase. The first and most well-known way is something called a conventional loan, which basically allows you to break up the payments on that home over the course of 30 years, and usually you have to put down 20% or more of the purchase price when you're first buying the home. Now, another very similar product is an FHA loan. Again, very similar to a conventional loan, only this type of loan product is backed by the government, which allows you to put down as little as 3.5% of the purchase price. This is huge for new home buyers, but the only downside to this is that when you're putting down less than 20%, you now have to pay for something called PMI, which stands for Private Mortgage Insurance, and that can add up as well. The next loan product you can use to buy a home is a commercial loan. Typically, you would only see this on very large multifamily homes or properties that have mixed use, businesses and residential and that sorts of stuff. Commercial loans tend to have a slightly higher rate than regular residential loans, and I don't think that they go all the way up to 30 years. I think they're a little bit less, but it does depend on the lender on that one. And then another method you can use, another loan product you could use to buy a home is something called a hard money loan. A hard money loan also has a higher interest rates than conventional loans, and typically you would use a hard money loan for a short-term project, such as a home that you buy that needs a ton of work that you plan on fixing up and then selling after. So these are great because while you're holding on to the home, usually you're only paying interest during that time. You're making interest only payments, and as soon as you get out of that hard money loan, you can now either get your money back by selling the house or refinancing into a different loan product. And then the last strategy for buying a home is a little less commonly used, but it's starting to become more common right now. It's something called creative financing or seller financing, which is essentially the person selling you the house, the seller, now becomes the bank. So instead of making payments every month to Wells Fargo or Bank of America or whoever funded your purchase of that home, you're making the payments directly to the seller. Now, obviously, the seller has to agree to this. You have to negotiate terms, but that's the beautiful thing about it is you get to negotiate the terms. When you're doing a conventional loan or an FHA loan, you don't get to tell the bank what you're going to put down or how long you want to stretch that loan out. But when you're negotiating with a seller, you can actually talk about those terms and make them a little bit more favorable for you if the seller agrees. So here's 5 different ways you could finance real estate. I'm sure there's more if you do even more research, but these are the most common ones that you'll find.